The two main strategies to trade the news are having a directional bias and having a non-directional bias. Having directional bias means that you expect the market to move a certain direction once the news report is released. This expectation is usually formed from a consensus by analysts that is released on a news event before it comes out. The problem with this method is that it's just analysts' opinion. However, some traders find success in figuring out before the news comes out exactly how it is going to affect the market. Of course, they never know 100%, but they can get a good idea. A more common news trading strategy is the non-directional bias approach. This method disregards a directional bias and simply says, there's news coming out, so there's going to be some type of big move in the market, whether it's up or down. Basically, the goal with this is to just be there when the market does move. So with the non-directional bias approach, we plan on entering the trade once the market makes its move in either direction. You don't have any opinion or bias as to whether the market will go up or down. This is why it's called non-directional bias. Let's move on to the next section and dig into a non-directional bias strategy called the straddle trade strategy. I personally use this strategy all the time and I love it, so I'll see you there.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.